I have a few questions that I
Okay,
can provide to you.
sure.
So, first one I want to give you is how are distributions from the cash value treated regarding taxation? I know you answered that in the middle, but if you could just answer it again.
Sure. So it's going to make sure that you take distributions. You can take withdrawals up to the cost basis without any tax implication, and then you're able to loan from the policy for any other distributions, which are going to be also treated tax-free. Because what's going to happen is at the end, when the death benefit is claimed, the loan's going to be paid back from the cash value that was there to pay off the loan, to then give the remaining death benefit to the client or to the beneficiary. So there's no tax implication as long as you're doing withdrawals or loans up to that cost basis. And that's why I said it's important to run that in-force policy, to not say, oh, the client can take out $30,000 this year, we're going to take out $30,000 next year due to dividends or whatever that may be, 30,500 or 29.5 or whatever it is. Reynolds in-force policies, but you are able to take out income from the policy tax-free. You're also able to surrender the full cash value, but with that, there may be tax implications. But for an income strategy, you are able to access the numbers that we showed on a tax-free basis.
Awesome. Another question I got was, people compare whole life policies to IULs all the time. So when does whole life have, or in what circumstances do whole life policies have a definitive advantage over IUL policies?
So I kind of that's a great question. I kind of touched upon this a little bit. It's for those clients who want those predictable and consistent results. As we know with an IUL policy, there could be some type of cap change, rates change, are already tied to the market. Zero is your hero, as they say, but zero is also not really growing that policy much versus a dividend paying out. So it's for the client that wants a little bit of that protection and that consistent results. I'll be totally transparent. A good performing IUL that is properly managed with a lot of good years early without any negative market years can outperform a whole life policy. But the whole life policy is going to have that kind of safe and steady, that slow and steady to win the race approach. So it's really going to be down to what that client is looking for. And really where I position whole life is as that non-correlated asset as part of their overall portfolio. So there's nothing to say that if a client has $10,000 of money that they've dedicated to insurance, that you couldn't go like 7 and 3, 7,000 into an IUL to have some of that upside, but 3,000 into a whole life to offer that kind of backbone and that consistent result. This is not an all or nothing game. For a lot of clients, especially ones talking, about whole life, you're normally talking about a little larger premium, and having that split sale will make sense because now you're diversifying their assets within their insurance portfolio versus, if you say, hey, I want you to invest everything in ABC company, they're going to be like, no, like I've been told to diversify my assets. Insurance is no different. So I hope that answered the question of kind of where to position it, but it is for a lot of clients that are looking for those predictable returns. And that's a way that if you're looking to position this for clients who are unsure of where to go and not saying, what's this versus an IUL, that's your kind of lead in of like, it's a non-correlated asset and you have these guarantees built in and it's that safe and reliable product that still has that upside. So that's kind of how I used to position it as well.
Yeah, I noticed that when when the market is super volatile, all of a sudden, insurance agents are asking us about whole life, and like you said, it's a sizable chunk of the industry. What I noticed is a lot of agents are also kind of stuck in that term space. I noticed that a lot of I came from a Northwestern Mutual background, so we just started with whole life. And as soon as I went into brokerage, I noticed everybody's selling term. So guys, if you know a guy that is interested in whole life or that you think would be a good fit, please call Matt or somebody at Penny to run you an illustration and help you tell the story. All you need to do is know a guy and bring that person to us, and we could tell you what to do with it. And right now, with this kind of volatility that we're experiencing, it's a really, really good time for you to identify those clients and talk to them. Another question, Matt, that I had was, I have two more, by the way. what would you say are the top 3 like whole life carriers that you might recommend?
So being with Penny and coming from Mass Mutual, of course, I'm going to say Mass Mutual is one of the top carriers I would recommend. Little homage to my former employer. But Penny is carrier agnostic. We work with a lot of major carriers, particularly with participating whole life. We have Assurity, Mutual Trust Life, National Life Group, SBLI, and Security Mutual Life of New York as our participating carriers. So it's really going to come down to what's going to be the best fit for that client out of the entire product range that we have to offer. And that's how I would really position things with the client, is kind of getting that risk analysis of what are they looking for, what are they trying to protect against, what type of insurance that they need. Bring that information to us, and then we can identify which carrier among our many carriers kind of fits that need best in order to then provide a solution for that client, as opposed to being like, this carrier is the best all the time, because that's not always the case. I mean, I do have some that I like more than others, but I will look at all of them on any particular sale to kind of understand what's going to be the best. So those are the ones we work with in the participating whole life space. We have more in the non-participating, as well as some final expense and guaranteed issue, which is kind of a different type of whole life. But that's kind of how I would frame that, is what's their risk analysis, and then let's find the product among all the carriers we have that best fits that client's risk analysis, because it may be different client to client.
Awesome. And then I saw a question from Brandon. I think it was more directed to me. I haven't been getting these recorded webinars. How are they sent out? The one last week wasn't sent out. It didn't record, so we had some tech issues, but this one will be sent out via an email to you guys after within the next 24 hours. So apologies for last week. The last question I'll end on, and this is really a preview for one of our sales concept webinars. So we are going to start really looking at situations that can get these types of policies sold for the right client, and really going in deep into them so you guys understand the ins and outs of how to sell to this client type. So the question is, you know, in your slide, Matthew, you mentioned using a whole life policy for things like education, grandparents giving education or weddings and stuff like that. So I would say the question is, how would you sell a whole life policy for college savings as opposed to, or in addition to, a 529?
So I think reading into what you're saying there, I believe we are going to have that particular topic. I believe I'm actually going to discuss that in a month's time or so. In the short term, to not give away the entire presentation, whole life is versatile. 529 is kind of locked into the college savings. So you're getting a lot of the same features and benefits. The one thing I will say is, for a client, you're going to have to look at time horizon as one of the main factors for determining between the two. Because, as you know, an insurance product does need time to kind of build up those values. So if they're looking to fund college 2 years from now, whole life is not going to be the solution. But if they, you know, have a grandkid and they have 10 plus years, that's when you can start looking at, hey, this is an option. And then if the grandchild does decide, hey, I've gotten a full ride, I don't need any of that additional money, or, you know, I'm becoming a rock star, I need to start my own business, like, they have the ability to access those funds in a different way. But we will have a complete presentation on that exact question coming up in the future, as well as some more in-depth ones on these particular things. But if you do have clients in the meantime that are fitting these needs, or you have questions about that, reach out to one of us here at Penny, and we're happy to walk through in more detail on a one-on-one of the client and of the kind of things that you're looking at.
Awesome. Okay, well, with that, that was the last question that we had. This was a really informative and awesome webinar. For those of you guys on this call, make sure you're on our email list, because we're starting to do these trainings almost every week, and we're already seeing great results of people bringing their cases to us, getting those cases in underwriting, and then getting those cases approved and issued out correctly the first time. So if you guys have anybody that you guys think would be a good fit, please call us. Matthew is available for you to call, as well as our other brokerage managers. And we are really, really excited to work with you. So with that, thank you, Matthew, for your time today. And I hope everybody has a great day.